So do you have random lists of things you need to look up, words you want to look up, terms you want to understand, issues, subject matter, things like that just sitting by your desk or sitting on your desk or maybe your nightstand? I mean, maybe you're about to buy a house or you're thinking about selling your house in a few months and you've never sold a house before. Maybe you have random questions in your mind and you'd like just a few of them answered. Well, I keep my random list going and going and going, and I thought I'd share with you 7 of my random topics coming up right now. Okay, random item number 1, we're going to talk about interest rates and we're going to talk about points. So when you're driving along in your car and you hear them say, oh, interest rates went up a point today, or interest rates went up a quarter point or something like that, or you're kind of working with a lender and you're learning about lender jargon and they talk points and they talk points all the time. Well, what does that really mean to you? What's an easy way to think about points? And the easy way to think about points is 1 point equals $300. So when interest rates go up 1 point, then your future mortgage payment is going to be $300 more. So if you have a $3,000 mortgage payment here in April 2021, if you purchased your house back in January, it might have been a $2,700 mortgage payment. I mean, that's a chunk of money. That's a big difference between a $2,500 mortgage payment and a $3,300 mortgage payment, right? And just a few months went by, okay? So here in 2021, interest rates are going up, but interest rates are low, all right? And I consider interest rates low until they get over 6 and 7%, all right? Historically, over the 100 years that people have been tracking interest rates, the average interest rate is 9%. I thought that was really interesting. In the last 5 or 6 years, we've been experiencing 2, 2.5, 2.6, 2.8, 3 point something, even 3.5%. I think they're eking up in the upper 3s right now. It's still great to borrow money at 3.8% or even 4%. You just want to know that every time that point thing happens, every time interest rates go up by 1 point, you're going to pay $300 more approximately on your mortgage payment. So start buying a house now. Okay, random item number 2 is down payment versus your initial deposit. Now, your initial deposit does become a part of your down payment, but initially it's your show me the money. You just made an offer on a house and the seller accepted it. And in the contract, it says you have to take 3% of the price that you offered to a title and escrow company to be held in trust. And that shows the seller that you're serious, okay? You've showed them some money. You've said, I'll give you some money up front to purchase your house, and I'm serious about my offer, all right? That opens escrow, and a whole other series of events occurs, which I talk about in my upper right-hand corner magical videos that are on my channel. I talk a lot about the whole process, okay? What happens after escrow opens. But right now, we're just gonna focus on the initial deposit. So if you buy a $700,000 house, 3% of $700,000 is $21,000. 3 times 7 is 21. Easy way to figure it out. So yes, you would be taking a $21,000 check to the title and escrow company. They hold it in trust while you make some decisions on that house, because you get to consider whether you really want the house after your offer gets accepted. All right, you're really accepting the offer contingent upon you doing some other work and investigation in the house. So it's just kind of sitting there until you decide it's a go, I want to purchase it, or for some reason you want to get out of the deal. So that's your initial deposit. And in the end, after 30 days of escrow goes by, the escrow company will be calling you to come in and sign your documents, and they'll tell you to bring in your down payment, all right? And they'll tell you what the calculation is, and it'll be minus the money you brought in as the initial deposit, all right? And they'll also tack on some fees on there as well. But they'll tell you how much to bring in on your signing day, which is the big day when you buy a house. You'll bring in, or you'll transfer through ACH transfer, which often happens, but you can do it through cashier's check too. You'll bring in your deposit, your skin in the game, your down payment. Really, it's not a deposit, I take that back. It's your down payment, all right? And so you bring that in, you sign your paperwork, and within 24 hours, 72 hours, depends what's going on, you eventually get keys to your house. So the lender way up front wants to see that you have a down payment, so you supply him with statements that shows you actually have the money. And then once your offer gets accepted, you take a little bit of that and you do the initial deposit at the title and escrow company, all right? And then we get through the whole buying process, and in the end, you bring the remaining portion of your down payment. Did I confuse you? So we have the initial deposit and the down payment. Both a part of the whole scenario, and that initial deposit becomes a part of your down payment, all right? That's it. If you know any more about that, leave me some comments below here, all right? All right, let's go on to random item number 3. Okay, random thought number trace, okay? So what is PMI or MI? First-time buyers, mainly and mostly, but not always, you could buy a house for less than 20% down on your third house and have to pay PMI. It's called private mortgage insurance. This is the deal. When you buy a house and you put in a lot of your own money, like 20% down, the bank feels more secure in giving you their money. So they don't really insure the money. Their insurance is if you fall out and stop paying your mortgage, they'll take your house, right? Well, if you put down less than 20%, they actually kind of insure their money with a mortgage insurance plan, all right? And that is an extra $200, $300, $400-ish dollars that's tacked onto your monthly mortgage payment, all right? And it's a chunk of money, and you don't want to pay it if you don't have to. And there's 2 schools of thought to that. The 2 ways that I see it. If you can't come up with 20% down, but you want to buy a house and you have the capability of buying a house, you have 3.5% to put down, and you want to step into the housing market and buy your first house and pay PMI or MI, mortgage insurance, for 3, 4, 5, 6 months, and then refinance. Often when you refinance, that mortgage insurance goes away because you've proven to the bank that you can pay mortgage responsibly and consistently for several months. So they take it away. Now there's different variations of that description, which I'm not going to get into in this video. Any lender that you work with will be able to explain that more thoroughly, and I will have lenders on my show that will explain it often throughout my video empire here on YouTube. But just remember, if you put down less than 20%, you'll have to pay PMI or MI. It's just a part of the deal. It's what the banks do because you don't have a huge chunk of money that you're putting into this big giant property that you're about to buy. Or maybe it's a little condo. Either way, if you don't have a lot of skin in the game, they cover themselves by insuring the mortgage, all right? So that's what PMI is, and you'll see that on a lot of your statements when you don't put down 20%. Okay, random item number 4 is what's the difference between a broker and a bank when it comes to getting your loan? Well, the banks, Bank of America, Wells Fargo, US Bank, whatever bank, they have investors that put money into that bank, okay? And then they make money when they loan it out to you to buy a house, to add on to your business, to do whatever. That's how banks make money, is on their interest rate, right? And they also have, so that's their pool of money. That's the Wells Fargo pool of money, or the Bank of America pool of money, or the Poppy Bank pool of money, or the Exchange Bank pool of money. These are banks in Sonoma County, California that I'm mentioning. And so they have their own investors and their own groups of money that they loan on. A mortgage broker is a private person, or sometimes it's a big company, okay, that shops around in all kinds of pools of money and kind of matches your needs and what you have going on with the best package of money for you. Now, I kind of favor mortgage brokers because they tap into all kinds of first-time buyer programs. They're aware of really all the pots of money that are out there that you can tap into. And I know my lender really matches people up to lending programs that work for each individual. And they have a broader scope of pots of money than a bank. Now, in a way, they all tap into government money for FHA loans and things like that. But there's private money and there's other pots of money that they work out of. So I think they have a lot more flexibility. Yes, you pay that mortgage broker a fee for what they do, but they're really like shopping for you, kind of like a realtor. They're going out there and looking at a big picture, not just bank number one's pot of money and bank number two's pot of money. So I recommend mortgage brokers. But you kind of have to shop around too when you're looking for a loan. And mortgage brokers sometimes don't do giant jumbo loans. That's kind of what, which are loans somewhere over, I think it changes every year, but like in the middle 600. So if you're getting a loan, that's not the price of a house, that's the actual loan amount. That's over like 650 or up in the 650 mark. Then sometimes the bigger banks have better interest rates, but not always. So it's worth looking around. So that's mortgage broker versus banks when you go to get a loan. Random item 5 is an FHA loan versus a conventional loan. Now, I typically think of a conventional loan as a loan that is done when you put 20% down as a down payment. I understand from my lenders that sometimes you can do conventional loans with less than 20% down. So that's something you'd really discuss with a lender, not me. But in my simple brain, I think of conventional loans as those that you do with a 20% down payment. What's an FHA loan? These are Fannie Mae loans. That's a nickname they gave to it. But FHA is a government loan. The American government wants Americans to own houses. So you don't have to put down 20%, you have to put down 3.5%. And because of that, let's just say you're buying a $400,000 condo or a $500,000 starter home. Well, 3.5 times 500,000, let's just round it up, 3.3% times 500,000 is $15,000. Let's make it 20,000. So you really only need to save up 20 grand as opposed to 100,000 or more to purchase a home. And this helps a lot of people get into their first time home, especially if you're buying a $380,000 condo or something like that. You can buy a house with $15,000. So it's kind of cool. So that's kind of the main difference between FHA and conventional. And lenders are going to educate you more than I, so I'm not going to go on about the difference. It's just people ask me randomly sometimes, what's the difference between FHA and conventional? And I always make it simple and say, well, with a conventional loan, you kind of need 20%, which isn't entirely true. I understand you can get them for less. I'm repeating myself. But A cool loan to get is an FHA loan, and you don't have to put down, a big chunk of money. Now, you will get that private mortgage insurance on it. That'll be included, but maybe in 3, 5, or 6 months, that'll be dropped from your mortgage payment. Happens all the time. So that's kind of my introduction to the difference between FHA and conventional loans. So random item number 6 is the credit topic. Now, I did a big long video on credit and my favorite book for cleaning up your credit, but here's a little random tip in case you're in the beginning process of getting prepared to buy a house. Here's a random tip. So the random tip is, and this is something lenders will often explain to you, is you don't want to pay your credit cards off. You want to have a balance. And I don't know what that is because it depends on how much your debt is, but you want to have a little balance right before they run your credit and put together your loan. They'll explain the details. Now, after you move into the house, after we give you keys, you want to pay that sucker off because you don't want to have debt when you have mortgage and all the other things I've talked about, all right? So get ready to pay off your credit cards, but don't do it in a crazy way where you get your balance to 0 because it doesn't help your credit score. I know that's loony, and you're thinking, what? I thought I had to have great credit, which means no debt. Well, yes, but ask your lender what that little strategy is. It's super important. I know my lender explains it to people oftentimes, and she helps them strategize through that little period, which is really when you're getting close to purchase, all right? So make sure you jump on your credit and you learn about it and you understand it, because there goes that subject again, interest rate. We want yours to be as low as possible. All right, so that's credit. On to the next subject. Item number 7, local lenders versus Uncle Charlie in Arizona, who's been a lender for 30 years, and you love Uncle Charlie. I mean, he wants to help you buy your first house. He's even going to give you $50,000 as your down payment. I hear these stories all the time, and they work out oftentimes. But the local realtor theory is keep the money local, because I know handfuls of the local lenders. And the local realtors know the lenders that everybody likes and the lenders that we're not so fond of, okay? I know the lenders, especially my favorite lender, who make sure that your deal happens. Now, I had no idea that really crummy stuff happens to people in the process of buying a house. Right at the end of the transaction, and it has to do with the loan, and they can't buy the house. Now, sometimes it's because of the stupidity, of the buyer who went out and bought a new car while they're buying a new house. Don't ever let me see you do that, okay? But sometimes it's the lender, and they didn't follow up, or something fell through the cracks, or something happened they overlooked that they should have done their homework on months ago when they pre-approved you, all right? And so then the deal dies and you walk away sad because the lender was all screwed up, okay? I hear occasional stories from realtors about this, and I'm just like, wow. I mean, it's amazing what can go sideways in real estate. So the local realtors know the local lenders. We work with them every day, all the time, and we trust them. And we know they can drive the deal forward and make it happen. And also, if you're a first-time buyer, my favorite lenders are really good at educating people about money and lending, so they know what they're getting themselves into when they go to buy a home. It's a big deal. It's not some random event. So, and you know what happens is you hook up with your realtor, you go through the process of buying the house, going through the inspections and all that, but in the end, Oftentimes my clients are better friends, better acquainted, and closer to the realtor almost than they are, closer to the lender than they are to me, because they've talked to their lender a lot. They're calling them frequently to say, can I afford this? If I bought this house, how much of a down payment do I need for this and that? And they're talking and they're working it through. So you become close to your lender, and you want to make sure that they know local stuff, and it matters. So as a realtor, I prefer my local lenders and my local money versus lenders that are in other states or from another county way far away, because I will have more control of your transaction, and so will my lender. So I vote for local lenders. So we're going to talk about fire insurance or homeowners insurance. They're both the same thing. You cannot get a loan without fire insurance or homeowners insurance. The lenders won't do it. And it's super important, of course, here in California, where we've learned a lot about fire insurance and what worked and what didn't. Many people here whose homes burned down were very, very underinsured. So if I were you, if I were thinking about putting all this stuff together and learning about how to buy a house, I would spend a little bit of time reading, learning, and talking to homeowners insurance brokers, because you want an education on it. And it is worth several, half hour, 40-minute phone calls and some time reading, because some homeowners insurance is not going to really cover everything you need to cover in 10 or 12 or 15 years. This is what people found out here in Sonoma County. They were way underinsured. So the cost of rebuilding their house was a lot more than their insurance covered. A real bummer. And you know what's an extra bummer that I found out after the fires is that people had purchased homes for cash, $1 million homes for cash, and $600,000 and $500,000 and $400,000 homes for cash, and they never got homeowners insurance, because when you purchase with cash, you don't have to buy homeowners insurance or fire insurance. So they didn't think about it. They didn't do it, and they lost the whole house. And I don't know how you recover from that unless you're already full of money. And then, of course, I guess you can rebuild, pull from some of your resources and build another house. But a lot of people had to just walk away, lose everything. So whether you pay cash or whether you have a loan, you've got to have fire insurance. It's super important. Fire happens and you just need it. Now, in other areas of California, you might want to think of flood insurance. That's super important. It's expensive, but you have to go explore it. You have to have a conversation with insurance brokers. And then there's earthquake insurance here in California. And I'm not an expert on this, but it is something worth mentioning that if I were you, I would go have a conversation about. It's exceptionally expensive. So everybody kind of gambles that there's not going to be an earthquake that topples their home. But you also need to make sure you know where you're buying. Is it smack dab on an earthquake fault? Because there's a lot of them around here. And if you can afford it, might be a good idea. It's something to ponder, but at least ponder fire insurance. That's the most important one, okay? And that's it. That's my random thought number 8. So do you have any random thoughts? I want to hear them. So what's a random thought I should do a video on? Let me know in the comments below. And while you're down there, check out my description section where I have a free ebook for you, a free buyer's guide, and a free seller's guide, and a relocation guide. And there's a great link down there to Homes for Heroes, because I'm an affiliate, which means if you're a local responder, a first responder, active or retired military, a teacher, a doctor, a nurse, I give you a really nice big check after you've purchased or sold your home because you're a local hero. This is a great national program, Homes for Heroes. check it out. And it's really fun to hand somebody a nice check after they've purchased a house, because they can go buy some great furniture or something, or just save it for a rainy day. Anyway, it's really special, so check out Homes for Heroes. Give me a thumbs up if you like this video. Hit that subscribe button and the little bell so you get all my future videos. This is Anita with Keller Williams Real Estate and Discover Sonoma County Living, and I hope to see you around the neighborhood.